Hey guys, I hope you're all doing good. I go by the name of Sipo, and today I'll be giving you a lesson on statement of profit or loss and other comprehensive income. Okay. This statement of profit or loss and other comprehensive income is of a partnership, not a sole trader, a partnership. Okay. And I'm using the prescribed book of FAQ 1601, the seventh edition. It's on page 74. If you're not using the 7th edition, just look for a trial balance that belongs to Vanilla Traders and is ending on 31 December 20.1. Okay, just look for it, and then if you find it, then we are all together. Okay, getting to the lesson of the statement of profit or loss and other comprehensive income. When we talk about the statement of profit or loss, it's where we want to calculate our profit for the year. Okay, and to get to our profit, we need to calculate three things, which is mainly the gross profit, other operating income, and other operating expenses. The incomes are added to the profit, the incomes are added to the gross profit, and then the total of it, we subtract the operating expenses to get our profit for the year. So the first thing which we always calculate for is the gross profit, okay? And then after, you can either calculate for other operating income or other operating expenses. It's all up to you. Okay, so our gross profit, the formula to get our gross profit is sales minus cost of sales. Sales minus cost of sales will give us our gross profit. So hence that's why the first thing we have here on our statement of profit or loss, but then I'd rather call it income statement to make it short. Income statement. So the first thing we have on our income statement is the sales amount of 595,000. Okay. So where does this 595,000 comes from? So all the totals, I'm taking them from this trial balance. Okay. All the totals are taken from the trial balance. But then we not only just have the trial balance, we also have our adjustments, as you can see, year-end adjustments. This year-end adjustments will affect some of the totals on the trial balance, and the effects, if they come to any changes of the totals, it will be represented here on the income statement. Okay. Okay. So the first thing which we had is sales of 595,000. So here is the sales amount. I took the total from the trial balance. So on the in the information which is given to you, now, okay, for instance, here on the trial balance, you see the sales amount. If there is nothing that affects the sales amount on the trial balance and on the adjustments, we record the amount as is because nothing affected it. But then what can affect our sales amount? What can affect our sales amount can be sales returns or a settlement discount granted to customers because they decrease our sales. You understand? Okay. So our sales is 595,000 and with no effect to it, so I recorded it as is. Okay. So I did a first video where I did everything from scratch, ne? But then after being done with the video, my voice was ahead of the video. Okay, so the video was left behind, so that whole video was not gonna make sense because the visuals were behind, my voice was ahead. So you understand? And then now the second entry we have is cost of sales. Remember, the formula to get gross profit is sales minus cost of sales. So the amount which we get as our total sales will be subtracted from our sales amount. Okay. So for our cost of sales, we have 195,990. That is the total of it. Let's go to the trial balance to check it out. Okay, here's it. Cost of sales 195,990. So now we see the total on the trial balance. So now you must look for anything that can affect the cost of sales, either increase or decrease. Okay, we have settlement discount received. So if we bought goods for a certain price, and then you receive a discount. That will decrease the cost of those goods. So settlement discount received will decreases our cost of sales. Okay, so it's 500. So we're gonna have the sales amount from the trial balance, okay, and then subtract the settlement discount received to get the correct amount of sales. So it's 195,990 minus 500 to get 195,490. So you represent this in brackets to show that you are subtracting this from the sales amount. Okay? So it's 595,000 minus 195,490. We get our gross profit of 399,510. As we've said, our gross profit is equals to our sales minus cost of sales. Okay? So now, as we continue, you can either start with the other operating incomes or other operating expenses, but then in this instance there were no other operating incomes. We only have expenses. Okay, so we're gonna do the very same thing which we did with cost of sales and sales amount to calculate gross profit. To calculate the other operating expenses, we are going to do the very same thing. We're going to look at the amount on the trial balance and then subtract the okay, we're going to take the totals from the trial balance, and then we will look at the adjustments, and then if the adjustments cause any changes to the totals here on the trial balance, they will be represented here under expenses. But then this is strictly for expenses, not that everything that appears on the trial balance we will cater for. No, we'll only do the expenses of the business. Alright, as the heading says itself, other operating expenses. So if there were other incomes, we were going to open our other operating incomes and then calculate for it, but then there are no incomes here. Alright, let's go to our adjustments. So I'd like us to start with the adjustments because they can be tricky. Like, let us start with the hard stuff and then finish off with the easy stuff, because the totals which are not affected by the adjustments, we will record them as they are. You understand? Okay, so the first adjustment says an outstanding debt of 300 is irrecoverable and must be written off. Okay, so we have a credit loss or a bad debt. Okay, so there's a customer which bought on credit and now is unable to pay on credit, so we must write that person off as irrecoverable. So that is an expense to us. Okay, that is an expense to us. It increases our credit losses. Okay, let's go back to our trial balance. I so hope this video doesn't just pause, because if it does pause, I'm not gonna do the other video. I'm not gonna do this again. Okay, credit losses. Oh, here they are. Credit losses amount to 500. Okay, credit losses amount to 500. So we had an additional credit loss, so our credit losses will increase. So we come to our statement of profit or loss. Under other operating expenses, you have credit losses. 500 is the total from the, where is it? Is the total from the trial balance. 500. Okay, and then 300, we will add it to the credit losses to show that our credit losses are increasing. We had an additional credit loss or an additional bad debt. Alright, okay, let's move on to the next adjustment. The allowance for credit losses must be adjusted to 708. Okay, now we are on the allowances for credit losses. So what happens is, on every year, a business will set an amount that it expects its credit losses to be. So the business can set 500 and say 500 is what we expect our credit losses for this year to be. That is the projected amount, not the actual. Okay, that is the budgeted amount, not the actual amount. Okay, and then if the actual amount appears to be bigger, for instance, our budgeted amount is 500 for credit losses. Okay, and then our actual amount for credit losses in this year, only to find out it amounts to 700. So that is more than what we budgeted for. So the difference will be an expense to the business. Okay, the difference will be an expense to the business. But then, if our actual credit losses are less than the budgeted, then the difference will be an income to the business. You understand? For instance, here, our actual credit losses, it's 708. Let's go to the budgeted one. Where is it? Allowances for credit losses. It's 600. Allowances for credit losses is 600. So now, the budgeted one by the business is 600. The actual is 708. So the difference will be an expense. It means our credit losses were higher than we anticipated. So it's going to be an expense. The difference will be an expense. So you look for the difference. It's 708 minus 600. You get 108. Okay. And then this is an expense. It increases our credit losses. Okay. We come to credit losses. Here's the 500, which is the opening balance, plus 300 of the bad debts. Here's the difference, 108. And then we add these three together, they give us a total of 908. So our credit losses, all in all, amount to 908. Okay, very simple. And then now we go to the debt adjustment. It's about depreciation. Depreciation must be provided as follows: equipment 10% according to the straight line method, and vehicles 20% according to the diminishing balance method. Okay, don't be confused by these two methods. They're very simple and very easy to understand. For example, the straight line method. The straight line method is the easiest because you just take the cost of the depreciation asset. For instance, here it's equipment. You take the cost of equipment, and then you multiply by the percentage, you get your answer. The straight line method. Okay, you always take the cost and multiply the percentage given to you. You get your depreciation answer for straight line method. But for the diminished balance method, you take the cost. In this instance, is the vehicle. You take the cost of the vehicle, you subtract the accumulated depreciation of the vehicle, and then you multiply using the percentage which is given to you. Very simple. Let's get to it. Okay, for equipment it's 10% straight line method. Equipment it's 20% on diminished balance method. Let's go to our trial balance to look at the cost. So for equipment, it's where is it? Equipment 70,000. Okay, so this is the cost of equipment. So you'll take the cost, multiply by the percentage. It's 70,000 times 10%. Okay, I did the workings here also. It's simply 70,000 times 10%. You get 7,000. 7,000 is our answer. Then we go to depreciation on vehicles. We go look for the cost. The cost is 80,000. It's 80,000 minus the accumulated depreciation for vehicles. The accumulated depreciation for vehicles is 39,040. Okay, 39,040. So it's 80,000 minus 39,040. We get 40,960. And then we multiply using the percentage of 20%. We get our answer of 8,192. And then we will add the two depreciations, which is 7,892. They will give us 15,192. And then you go to your income statement, depreciation, you add the two, you represent it, and then that's it. Nothing hard about depreciation, guys. Alright, now let's move on to the next transaction. Okay, the terms of the mortgage provide for interest of the loan to be calculated at a rate of 15% per annum on the outstanding amount of the loan at the end of the financial year. Interest is payable in the first week of January following of the following year. During the 2022 financial year, the partnership will start repaying the loan at an amount of 20,000 per annum payable to January of every year until the loan is fully paid. The loan is secured by mortgage over land and building and was originally granted to the partnership by a Capital Bank Limited on 2 January 2020. Okay, so now what we have is we have a mortgage loan which is secured by land and buildings. So what we need here, we need the interest payable for the year. Okay, if you want to know the interest payable for the year, this is what we will need. The 15% is what we're going to need. Okay, so we take the 15%, then we go to our trial balance. We look at the cost of the mortgage and of the secured loan. It's mortgage, it's 120,000. So you say 120,000 times 15%, you get 18,000. 18,000 is the interest payable for the year. So it's 18,000. Then you record that on your trial balance as I did. Interest on loan, mortgage loan, it's 18,000. Simple. And now let's go to the next transaction. Okay, Avon granted an unsecured loan to the partnership on 1 September 2021. According to the terms of the loan agreement, interest at 9% per annum will be charged and is payable in January every year. The total amount of the loan will be repaid in full on 30 June 20.5. Okay, so now we took a loan, but so what you must always look out for with loans, it's when the loan was took. If the loan was took during the year, then you must know that the interest is not payable for the whole year. It's payable for certain months, maybe 4 months, 5 months, 6 months. You understand? So you need to be very careful so you can calculate the months correctly. Okay, and you must know when the business financial year starts and ends. With our business, it starts on the 1st of January and ends on the 31st of December. Okay, and then this loan was taken during the year on 1 September. Alright, so you need to calculate the number of months. So it's September, October, November, December. So this loan is for 4 months. 4 months. So we need to calculate the interest on it. Okay, let us do it out. It's also very easy. Let us do it all together. What's important here is for you to be able to calculate using months. Other than that, then it's very simple. Okay, so now we go to our trial balance to go check out the cost. Long-term loan Avon is 30,000. The cost is 30,000. Okay, we take the cost, multiply by the percentage as we did with the mortgage loan, 30,000 times 9%. But then now, this loan is not for it's not for 1 year. It's for 4 months. So you will further multiply using 4 over 12 months. Okay, then you get your answer of 900. And then that answer is what you will record on your income statement. Interest on loan. Okay, so let's say long-term loan. Okay, anyways, it's 900 as you see. Very simple. Very simple. What's important is for you to always be careful for those ones. It's always know when the loan is taken. If a loan is for the whole year, then you must provide interest for the whole year. And now let's move on to transaction number 6. Advertisement expenses include an amount of 400 which was prepaid for January 20.2. Advertisement 400 prepaid for January 20.2. Okay, so now we paid for our advertising for more than a year. Remember, our financial period ends on December. So our 12 months is from January to December. So we paid for an additional year in advance, and that money is included on our current year. So that amount will need to be subtracted. Okay, will need to be subtracted. So we go to our trial balance. We go to our trial balance. Let me see. Where is our advertising? Advertising is 7,400. Okay, then we come to the income statement. We look for advertising. It's 7,400. Then we minus the 400 which was paid in advance. So this 400 was paid in advance. It was and prepaid expense. Okay, so that needs to be subtracted. Because it does not match the current financial year using the matching principle from the generally accepted accounting principles. Alright, and then now we move on to the next transaction. During the year, the following cash salaries were okay. The amount paid for water and electricity excludes an amount of 2,300 still payable for December 20.1. Okay, so there is a money which we are supposed to pay, but we have not yet paid for it. But then that money falls under the current financial year, so that money will need to be provided for. Okay, so it will need to be added on the current financial year, which is 2,300. So it's 12. Let us go to our trial balance. We go look for water and electricity. It's 12,100. And on this 12,100, we will add our 2,300 from the adjustments. This is the money which was supposed to be paid during the year, but then has not yet been paid for. But then it falls under this current financial year, so it needs to be added using the so guys, what's happening here? All the costs which fall under our financial year must be added. All those which do not fall under our financial year cannot be added. You understand? They will need to be subtracted, those ones. Easy. I hope this thing is recording, because if it's not recording, it's a pity. It's not recording. Okay, so now we are okay. Let us look at the last adjustment. It's during the financial cash flow. Okay, this one will be dealt with on the statement of changes in equity. Okay, even this one will be dealt with on the statement of changes in equity. Okay, these two will be dealt with on the statement of changes in equity. So it's not necessary for us to do them. So now we go back to our trial balance. We look at expenses which were not affected by the adjustments. Okay, so advertising was affected. Bank charges was not affected, so we record 2,300 as is. Telephone expenses were not affected, so we record them as is. Water and electricity were affected. Salaries, record them as is, they were not affected. Insurance, record them as is. Delivery expenses, record them as is. Credit losses, these ones were affected. And then interest on bank overdraft, it's also not affected. We record it as is. Stationery consumed, we record it as is. Settlement discount received, we provided it. So we subtracted it from the cost of sales amount. Okay, and then now you will add all your totals, all the amounts appearing under expenses. You add them all together to get the total amount of 144,200, which belongs to other operating expenses. Okay, and then now and then we subtract it from the gross profit amount. So it's 399,510 minus 144,200. Okay, but if there were incomes, if there were other operating incomes, we are going to add them on the gross profit and then subtract the other operating expenses, but then they're not here, so we just subtract the other operating expenses. Then you get your profit for the year of 235,810. I hope you guys understood the video and everything was pretty much straightforward and very simple. For me, this is it. Thank you.